Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Brian Stutland, Managing Partner at Equity Armor Investments, as well as Mike DiBernardo. He's Managing Partner at Allmon, DiBernardo Associates, a CPA firm specializing in high net worth tax planning. We're here to discuss tariffs, taxes, and the potential impact to business and personal investments. It's great to have the both of you with us. Welcome to Trade Talks. And it's interesting, Brian, markets are hitting all-time highs. The VIX remains well above its lows. So that does seem to signal underlying uncertainty. And if you take a look at the market where we are now relative to the beginning of the year, it seems to have somewhat of a quiet market. But when you peel all those layers back with everything that's happened in between, that's really where the story is.
When you look at what the markets have done over the last year, Jill, it's just been a wild ride, right? I mean, we've seen the Nasdaq go to 22,000, back to 18,000 on the tariff news. And you mentioned the VIX being somewhat elevated. Yeah, that's true. And so I think that's sort of reflective of what the Nasdaq and the rest of the broader market has kind of done in this sort of market environment of uncertainty. And obviously, just, we're at the first half of the year, right? And just looking back, the two big news stories have really been tariffs and geopolitical risks. The geopolitical risk thing seems to be abating a little bit, and that's why we're getting such a rally. I take a look at the Nasdaq, Jill, if I could just share that. You look at this movement that I talked about, and it basically engulfed a year's worth of back and forth and took off to the upside in recent weeks here. So this really could be, from a technical picture, lead the Nasdaq to another, let's say, call it 4,000 points higher. If you look at that range, 22,000 to 18,000, and you've seen the jump and break out to the upside. And so that is something that maybe there's a fear of missing out going on now in the market. And that's why maybe the VIX is elevated.
Well, Brian, even though we're at these levels right now, 72% of CFOs expect tariff-driven inflation. We are in a quiet, I don't want to say quiet period, but the only thing we've had in June is what's coming out of the headlines, not just as it relates to tariffs and so forth, but certainly geopolitical instances as well. I think once we get into the July and August reporting season, this is when you might start to see these tariffs being passed down. And once economic data catches up with that as well, I'm curious to get your thoughts on how you think earnings is going to play out, because this might start to be where we see this trickling down to the consumer.
When you look at the S&P earnings, they're expecting about a 14% growth rate here. And forward PEs are pretty elevated. I mean, they're sitting up around like 22, 23 on the S&P if you're going out, looking forward 12 months. So, valuations are a little bit high. And yeah, we're probably going to get some clarity coming up here at the end of July in the earnings picture on seeing how these tariffs have impacted businesses. Because, like you mentioned, CFOs have been very gun shy on what they want to spend on, how they're going to do it, where they're going to reallocate import manufacturing and whatnot. And so that's been a lot of uncertainty. If we get some clarity, maybe that's why the market is sort of breaking out to the upside, because maybe we're finally going to get some clarity to all this and some certainty as to where the earnings picture is going to go. But valuations are a little bit elevated.
And Mike, Brian's painted a picture of market highs with some caution in here. As a CPA in California, you're not seeing the same wall of worry from the VIX. What are you hearing from your clients about how they've managed tariff challenges, and does this support the market's record highs?
Yeah, thank you, Jill. What we've seen with our clients, most of ours are not in the imports or logistics business, but we do have some that are, and they had some shock early on, but they've been able to adjust their supply chains and think forward about how to be more resilient in an environment where there might be tariffs. And then on the side of the clients that are not involved in imports or logistics, we haven't really seen much consumer weakness from them. So most of our clients that are providing services to consumers are actually seeing years that are trending to be record highs for them. So we haven't seen much consumer weakness either.
It sounds as if businesses are absorbing the tariff shocks without significant disruption. What is countering that? Is it consumer spending? Is it expectations that there might be a friendlier tax stance within the clients that you service?
It seems to be that everyone appears to be of the opinion that there might be a calm in terms of the trade wars, and there might be some sort of off-ramp that people can live with. And then in the long term, people are adjusting how they source their products and also adjust the type of products that they are providing to clients so that way they're not as susceptible to tariffs in the future.
One big, beautiful bill, of course, it's racing towards a July 4th deadline. Mike, let's start with you and how the proposed SALT cap increase could affect Californians.
At the moment, the cap is $10,000, and the House proposal would increase that to $40,000. The Senate, though, has said that they want to keep it at 10,000. So I think ultimately we might end up with some compromise in the middle. That's just kind of the sentiment that we're seeing. In addition to that, though, they've talked about eliminating some of the workarounds that the states have implemented. That's the PTE workaround for business owners, where they can pay their state income tax, their personal state income tax through the business. So both bills have talked about eliminating that workaround that the states have developed. So I think ultimately what we'll end up with is a slightly higher cap on the SALT limitations. But for our business owners, not having that PTE workaround is ultimately going to put them in a situation where they're able to deduct less of their state taxes.
Selfishly, as someone who lives in New Jersey, SALT is something that we've been following as a homeowner, especially. How could SALT impact in a positive way homeowners?
Well, I think the any increase above 10,000 for individuals in high tax states, high income tax states, and high property tax states, that'll be some relief. But they've really, even with a $40,000 cap, what we see is that for most of our clients, the combination of the property tax and the income tax is well above that. So I think it'll be a little bit of a reprieve if the cap is increased, but it's not going to be like what it was before.
Yeah. And Brian, let's talk about this through the lens of the market. What are some of the pros as it relates to the tax bill?
I think when you look at it, I mean, it acts as a stimulus, right? I mean, that the SALT cap that we're talking about here, to go from 10,000, let's say, to 40,000, that's more money in people's pockets. That money has to go somewhere in the system of our economy. And so you'd expect that to give a little boost. I think as we sort of turn the page on the back half of the year, we talked about, it's all been about tariffs and geopolitical. When you turn the page to the second half of the year, I think it is going to be about this tax bill. What's going to happen there? Does that act as a stimulus to some degree? And then also, couple that with the Fed. Are they going to be able to cut rates, or is inflation going to continue where they have to hold up? There's been some Fed governors saying, yeah, we're going to be able to cut rates maybe in July. And then Paul kind of like backed off that a little bit the other day in his statement. So I think a couple of these things between the taxes and the Federal Reserve now, I think that's the page to sort of turn and look at here in the second half of the year. And is there enough stimulus in there to sort of push liquidity higher and push these markets higher?
You just mentioned the word stimulus. We can't ignore the fact that our fiscal policy is just unsustainable.
That is the one concern. And I think, let's just take a look. I know we talked about the VIX and the markets right now, right? And as you sort of look at that, you can kind of see here that the VIX, that this is the Nasdaq here, hitting all-time highs. But you look at the VIX, it's made higher and higher lows. So every time the market's gone up, the VIX actually has been somewhat elevated. And Jill, I think this debt situation, is this really sustainable? I think this has people a little bit concerned in terms of the credit markets on where things can go. Can interest rates actually get down to where people are expecting? And I'm a little bit cautious about that. If I was, managing a portfolio right now, I would probably want to own calls on the market rather than outright own the market. And then that's probably what you're seeing with the VIX elevated somewhat, the Nasdaq hitting new all-time highs. There's obviously this concern on is this really sustainable on what we're doing in terms of government policy?
Brian, to wrap this point up here, it sounds like there's two things. If this bill fails to pass, or if there's SALT doesn't get increased, it sounds like those two factors are really what this is weighing on in terms of how the market is going to interpret it.
Yeah, and like I said, I think that's what we're looking at really next week, right? That people expect maybe the tax bill comes to fruition here before the 4th of July, gives people a 4th of July present. If it doesn't, obviously Congress will take their vacation time here during the late summer, and we'll come back, and maybe in the last quarter we'll see this stimulus, sort of take its effect on the markets. But again, I caution both valuation at this point and, is this a sustainable tax package to have? It looks like it can be, but the debt's an issue, right? That's something to worry about. Maybe not in the second half of this year, but certainly down the road.
Let's wrap up here, Mike, with the impact to investors. This is something that we can more freely relate to here. When it comes to retirement accounts and investors seeing the volatility, that's happened over the past 6 months. How are you advising them? I would imagine diversification is certainly one of the avenues that you're pursuing.
Not only asset diversification, but also diversification in the location of their portfolios. So with the debt potentially being an issue, as we alluded to earlier, it's very risky to have a significant concentration in pre-tax retirement accounts, especially for clients who have a taxable estate. So what we're recommending people do, especially if this tax bill passes where the rates are going to be lower and the brackets are going to be wider, we're recommending that clients look at Roth rollovers this year and in the immediate future years, so that way they can relocate their assets from taxable accounts to post-tax accounts.
And Brian, to wrap up here, you suggest avoiding blanket investments. And then I want to also ask you from a trader perspective, when you're managing risk and you have markets moving the way that they are, how are you thinking about modeling out that risk?
Well, I mean, I think when you look at the level of volatility, I think it's important to own volatility itself as an asset class. You can do that by trading VIX futures. You can trade long options contracts in a portfolio. So have some sort of option trading asset allocation in a portfolio, because I think when you look at this market, we've seen so many of the defined risks where people are sort of, participating in the upside, but they get called away. And they're getting called away right now as the market rips higher. Some investors are not participating in it. So I think, the traditional 60-40 had some struggles with interest rates moving higher, obviously in 2022, 2023. That's kind of maybe normalized a little bit now that the 10-year sort of settled in this 4% sort of range. But certainly, the more you can find different kinds of asset class to invest in, both liquid alternatives and your traditional ways of investing, I think that helps you kind of participate in different market environments, lowers volatility, you stay in for the long haul. And that's really what we try and focus with investors.
Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.